Tourism in Las Vegas in a big slump this summer, costing the city billions.
It's one of the newest attractions of the Strip. Concerts have some of the hottest tickets in Vegas, but the company behind the Sphere is reporting big losses. Sphere Entertainment executives reported a $125 million loss and $127 million in revenue for its recent quarter.
Las Vegas didn't build the future of entertainment. It built a $2.3 billion glow-in-the-dark money pit. The Sphere isn't a venue. It's a neon black hole swallowing cash while James Dolan parades as a visionary with other people's money. Keep watching, because in the next few minutes you'll learn the simple math that turns sold out into red ink, exactly where the $2.3 billion actually went, why the content model is structurally broken, the real story behind the CFO's exit, what discounting signals about demand decay, and the only path that gives this thing a fighting chance. Plus, whether Abu Dhabi is a lifeline or just a stall before impact. Let's start with the illusion. You see 50 million LEDs pulsing in the desert, and it feels inevitable. Of course, this is the future. Inside, the screen wraps over your head like a digital sky, bass rumbles through the floor, and for 120 minutes you forget gravity. The hype writes itself. U2 crushes opening night. Darren Aronofsky drops a bespoke cinematic trip. Influencers lose their minds, and the media crowns it the new capital of wow. From the sidewalk, it looks like a license to print money, but the sidewalk lies. Because the cash register does not care how awe-inspiring your dome is. It only cares about unit economics. The Sphere reported losses in the 9 figures, even as lines wrapped around the block. Wait, how can that be? 17,000 seats times hundreds of dollars, that's a fortune. Great question. Let's do the math like adults. Revenue is seats times price times frequency. Costs are everything the brochure doesn't mention. Armies of engineers to maintain a purpose-built screen the size of a football field, an exotic sound system that can't break, ever. HVAC for a small city, security, insurance, union labor, marketing, licensing, content production, and a debt stack that wants to be fed whether the show is full or not. If your nightly operating nut is gigantic, even a sellout can be a loss, especially when your headline act takes a fat cut. Your resident film has limited repeatability, and you start discounting to keep bodies in seats. That discounting matters. Price is a signal. When $119 tickets become $99, you can call it accessibility, but the market hears demand is softening. And when the camera pans across empty sections during what should be a slam dunk night, investors start asking harder questions then. Is it pretty? Now, where did the $2.3 billion go? Follow the money. Roughly $1.4 billion poured into the shell. The steel exoskeleton, custom exterior LEDs, seismic reinforcement, and the bones to hold 17,000 people under a digital sky. Another $600 million into the guts. The 16K, class interior screen, motion sync seating, exotic audio arrays, and bespoke control software. Nothing off the shelf, everything custom. The rest, hundreds of millions, went to the machine behind the machine. Salaries, consultants, legal, insurance, marketing, and a content studio spun up so the Sphere wouldn't just be a room. It would be a platform. Here's the catch. Most of that is sunk cost with ongoing upkeep. You don't just flip a switch on the world's most complex LED dome and call it a day. You carry it. Every day. Forever. So even if your top line looks impressive, $120M-ish in a quarter, the bottom line can bleed if the overhead is mismatched to the revenue model. That's how you get the headline nobody wants. 9 figures of losses with packed crowds, and then the red flag you can't ignore, the CFO exit. In the real world, CFOs don't quietly resign during smooth sailing. They leave when strategy gets fuzzy, when the cash curve looks scary, or when the boardroom can't agree on how to stop the bleeding. You don't need an MBA to read that tea leaf. This is where we need to talk about the content trap. The Sphere isn't an arena, it's a single-site, single-format content machine. Traditional entertainment scales horizontally. A film releases to 100 countries, a tour hits 40 cities, a Broadway show spawns road companies. You amortize your fixed costs across the world. Sphere content is the opposite. High-cost experiences that can only be monetized inside one building in one city. That means every project lives or dies on local ticket sales. No streaming. No wide theatrical. No global tour. And once you've wowed the tourists and locals, repeatability drops like a rock. Now add the headline act problem. Marquee residencies drive spikes, but stars demand star-level economics. Great for buzz, not always great for margins. When the residency pauses or the novelty curve cools, you're left holding the bag. Same costs, less revenue. That's how a breathtaking innovation turns into a breathtaking burn rate. So, is this just Dolan being Dolan?
Partially.
James Dolan is the archetype of the ego-driven builder. Big swings, bigger budgets, and a belief that the world will bend to the vision. Sometimes that works. Madison Square Garden is still a money printer. Sometimes it turns into a case study in hubris. The Sphere is his moonshot. Visionaries change industries, or they write very expensive cautionary tales. Let's pressure test the business from first principles. 1. Capacity and frequency. If you can't run a high-yield program most nights of the year, you can't spread fixed costs thin enough to win. Gaps kill you. Point 2. Yield per seat. Price has to stay premium without collapsing occupancy. When hype fades, pricing discipline is the first casualty. Point 3. Mix. Residencies plus proprietary films plus corporate rentals and esports and special events. If that blend can't smooth the calendar, you feel every lull. Point 4. OPEX control. Exotic gear means exotic maintenance. If technicians outnumber ushers forever, your cost base is wrong. Point 5. Capital strategy. You can't keep raising to cover operating losses. Debt doesn't care about your Rotten Tomatoes score. Where's the non-obvious upside? The exterior. The Sphere's outside is the most visible billboard on Earth. Selling that canvas at premium rates for tentpole moments is real money if packaged correctly. F1 week, Super Bowl week, global product launches. Sponsorships can blunt the burn. Also real. Private events. High-margin corporate bookings, award shows, convention center overflow. But again, those can't carry a building this expensive alone. So what's the plan? The only route that pencils is franchise-style expansion without the capex burden. License the tech, license the content, export the brand. Abu Dhabi wants a Sphere? Perfect. Let them fund the shell while you sell the brains. With 2 or 3 domes, you can amortize content across multiple sites, stagger premieres, and sell advertisers multi-city reach instead of a single zip code. That's a business, not a sculpture, but that plan has prerequisites. You need reusable formats that travel, modular shows that slot into any sphere with minimal retooling. You need a content pipeline that doesn't rely on one tour at a time. You need pricing that sustains premium perception without the constant fire sale. And you need a governance structure that keeps vision in check, because every what if we is a future invoiced at let's talk scenarios. Bull case. Licensing deals close. Abu Dhabi breaks ground on someone else's dime. 2 more cities sign letters of intent. The content slate standardizes around 3 anchor experiences per year plus rotating residencies. Exterior ad sales become a 9-figure line by stitching together global campaigns. OPEX falls as maintenance protocols mature. Losses narrow, then flip. Base case. 1 licensing deal lands, content improves but remains hit-driven, residencies are sporadic, and ad sales help but don't transform. The Sphere soldiers on, iconic, busy, and barely break even, with periodic cash calls and a stock that trades on rumors. Bear case. No second dome, residency slow, repeat visitation fades, discounting becomes structural, and capex creep outpaces savings. The Sphere becomes the world's most spectacular write-down, a marvel to look at, a mess to own. Where are we today? The numbers say novelty is not a strategy. First-year dazzle is behind us. The question is whether management can turn a prototype into a platform. That means ruthless cost work, disciplined programming, aggressive exterior monetization, and, this is key, humility. The building is perfect. The business isn't. Fix the business. If you're an investor, here's your cheat sheet. Watch pricing. If floor prices keep sliding, demand elasticity isn't your friend. Watch calendar density. Dark nights are silent alarms. Watch headliner economics. If only megastars move the needle, margins will always be hostage. Watch content cadence. 1 new signature experience per quarter is the minimum to keep repeatables alive. Watch leadership. Another finance departure? That's not noise. Watch licensing. If a second and third Sphere ink deals, the model's defense gets reeled. So is it worth $2.3 billion?
As art, yes.
As engineering, absolutely. As a business, only if it becomes many spheres, not just one. The dome dazzles. The spreadsheet decides. Your turn. Is the Sphere a misunderstood platform on the verge of scale, or the most beautiful cash furnace in Vegas history? Drop your take below, then tell me,